Hi, everyone, and welcome back to Applied International Economic Policy. This is the seventh topic where we'll be discussing the causes and consequences of the Great Recession, which is a follow-on from the matter we were discussing last week, namely this emergence of a debt-led model and an export-led model, and how these two sort of growth modes lead to current account imbalances, but as we'll also see today, instability. So in today's lecture, we're going to discuss, we'll begin with a timeline of the Great Recession, just to remind ourselves of how these, how the instability kind of spread out from its source in the US and infected the rest of the world, in order to try and get a better understanding of how instability works in modern capitalist economies. We'll then link it to the theory that tries to explain the crises more generally, and then more specifically regarding this crisis, the real and financial factors that cause the crisis. And then before we'll finish, we will look at the consequences of this crisis on health and politics and race and gender. So we'll really try to underline the significance of this crisis in particular. And then, of course, we'll, as always, consider some ideas for policy at the end. Okay, so a timeline. I'll begin here, as I guess a lot of these sorts of timelines begin at the house price bubble in the US, but also in the rest of the world. The US house bubble is particularly important here because it's the one to burst first. And of course, the bursting of this bubble likely leads to the bursting of all the others, but at least let's see here that between 2002 and 2005 or 6, there was this phenomenal growth of house prices all across the US. And then it plateaus for about a year until 2006 and then starts to fall. In the other economies listed here, it takes place a bit later and perhaps grows even further. If you see Spain, for example, or Australia is particularly bad. But the US, the bursting of this US bubble is a trigger for what is to follow. In particular, if we consider all those houses that were bought using a subprime mortgage financial product, which is essentially just a mortgage, except it's classified as a high-risk mortgage because those people who have taken out the mortgage are considered less likely to be able to pay back their mortgage. And around the time that house prices start to fall, in around 2006, we see that the rate of delinquency on subprime mortgages really starts to pick up. So delinquency is simply if you fail to pay back your mortgage for 60 days or more, then your credit institution will declare that your mortgage is delinquent. And if you fail then to pay back for, I think, 6 months or so, then that mortgage is considered defaulted. So it's kind of, a similar kind of measure, if you like. It's just about the time frame. And as we see, after 2006, these subprime mortgages, like up to more than 40% of those subprime mortgages are considered delinquents. And after the subprime mortgage, delinquencies rise, even the less risky or rated as less risky mortgages also pick up as this kind of morphs into something much worse than just a subsector of the mortgage market kind of blowing up. It becomes a full widespread economic crisis. But at the moment, we're only in 2005, 2006, and now in 2007. We see that delinquency rates and defaults rise across the whole housing sector of the US, because this is the delinquency rates across the US housing markets. And it really picks up and stays quite stubbornly high for the years to follow. So already by mid-2007, this subprime mortgage sector begins to spill over into the effects on commercial banks. In particular, what we start to see is that commercial banks no longer trust each other as much as they used to. So at the end of every day, commercial banks need to ensure that their assets and liabilities match. So if they've made more loans than they have assets, then they, saving and so on, then they need to ensure that those things balance. So they need to go to the markets and ensure that they have enough funds for assets and liabilities to balance. And if they have, more saving than loans, then they have excess funds that they can loan to other credit institutions and other banks, and so on. And that's the interbank interest rates, or the LIBOR rate is often considered a kind of a key benchmark figure. The London interbank overnight interest rate, I believe. But what we see here is that LIBOR rate, the difference between that LIBOR rate and the government treasury bond rate. So this is what is called the TED spread. So as the TED spread rises, we see the difference between the interbank rate and the government's treasury bond rate grows. And because the government bond rate is considered risk-free, then the TED spread therefore measures the amount of risk or perception of risk between commercial banks. So if it rises, then it shows that commercial banks don't really trust each other. They'd rather hold on to their own funds rather than lend them on again. Yes. So, and if they do so, they would rather charge a higher interest rate to compensate for that risk. And so already in mid-2000, we see this TED spread, this measure of distrust, if you like, between commercial banks really starts to rise, even before the recession is officially declared, as you see, where the recession is marked in grey here. So of course, the monetary policy must see this and say, okay, well, this is a problem. Commercial banks are not happy to lend to one another. There's a crisis of confidence. We need, as the central bank, say the Federal Reserve, need to step in and ensure that there is easy access to credit for all commercial banks and for all commercial enterprises that use commercial banks. And they do this through their open market operations. They try to ensure the interest rate falls, so that there is liquidity always being supplied to those commercial banks with the hope that they will then pass that on to commercial enterprises in the form of loans for real investment and so on. And so this is already beginning again around the same time, mid-2000. So this is the one half of the monetary policy response to the financial crisis. The other is quantitative easing, which we'll get to soon, which also begins around the same time. But we see this dramatic fall, especially here in the US, but across the world, to virtually zero rates of interest that the banks, commercial banks, are charging one another, and that the central bank is facilitating in some sense. Then in 2008, after this onset of cheaper interest rates or lower interest rates, in 2008 we see the collapse of many of the large US investment banks. First and foremost, we have Bear Stearns already plummeting due to their high exposure to these subprime mortgages or securities consisting of subprime mortgages, essentially. And then, well, I think they get bought up by a competitor around May at a much lower share price. But it's Lehman Brothers which really takes the world by storm months later, in I think October 10th or so. And Lehman Brothers just is wiped out. It goes bankrupt. There is no buyer. And Lehman Brothers, keep in mind, is the fourth largest investment bank in the world. So a really sort of structurally important player. And this sends shockwaves through financial markets and real markets too. Merrill Lynch, on the other hand, also, I mean, they all plummet, but Merrill Lynch is also taken over by, I think, Bank of America later. And as we can see, collectively, investment banks, their stock prices are plummeting, wiping out wealth of those who own them, and having follow-on effects. Of course, at this stage, the governments across the world are taking notice and are extremely worried. And therefore, we see a massive increase in, at least, in government spending between 2008 and 2009, because remember, there was always a policy lag. So although things were getting already quite hairy in 2007, it's only in 2008 that these investment banks go under, and by 2009 we see this fiscal response, the stimulus package that always takes a bit of time with parliamentary procedures in order to get through. But already before then we see some automatic stabilizers in many of these economies kick in. So unemployment benefits go up, for example, if there's an increase in unemployment, and that helps soften the blow to some extent. The US, of course, being the first economy, being the economy where the crisis began, has a quicker response because, well, in some sense, it's affected earlier on. But also we see that in, say, Japan, there's an earlier response too. Okay, so this in some senses you can call emergency Keynesianism, because these governments aren't necessarily, you can't really characterize their behavior as Keynesian, but when it comes down to it, at the end of the day, when there's a crisis, they know that in order to stabilize the economy, to ensure unemployment doesn't get too high and so on, fiscal spending must expand and provide stimulus for the wider economy. So the world economy is now, well and truly affected. By 2009, we see a massive contraction of trade by 10%, and it was shrinking already before that. GDP around the world really nosedives, and inflation falls, not quite into deflation territory for many of the world's economies. I think for the world average, I don't have the world average here, but for say the euro area, it's just gone down. So we have disinflation, but not deflation. It's only really in Spain, United States, and Japan where we see dangerous or potentially dangerous deflation. Because of course, deflation, has these very sort of destabilizing characteristics, affecting the relationship between, lenders, borrowers, and savers or creditors, debtors, and so on. And of course, it means that those who, if you know what deflation is in effect, then you might as well wait until next year to spend rather than spending today. So all of these destabilizing properties. What's interesting with inflation is that we see in the European economies in particular, there is this sort of second dip that comes around 2015. And we're going to go into the causes behind that in time. Similarly, unemployment, it rises, but due to the onset of fiscal expansion, many of these economies is not as bad as it would be otherwise. Otherwise, we could probably expect, Great Depression era levels of unemployment of 20 or 30%. But in most of these economies, it's simply just a small or relatively small uptick in unemployment between 2008 and 2009. But of course, we see in Greece and Spain, it does rise to, Great Depression era levels of unemployment just a few years later. And again, this is due to the structural nature of the eurozone, and in particular, the lack of a lender of last resort. So the ECB being different from other central banks in that it did not automatically guarantee the debt of all its sovereign nation states or member states. So it couldn't ensure that Greece could spend as much as it needed in order to stabilize or reach full employment and so on. Interestingly, Germany here is the real outlier in that unemployment is falling essentially throughout the period of analysis. So this is, somewhat remarkable given the state of the world. Of course, GDP is falling, but unemployment isn't rising so much in Germany at the same time. And this is largely to do with the different economic structure of Germany being an export-led economy. Its house prices did not rise so dramatically, and its debt levels were not so unsustainable. So all the effects on Germany are pretty much coming from the outside. The effects in terms of unemployment are quite different. So going into the causes behind these large rates of unemployment, we come to the next part of the Great Recession. So we're kind of leaving the global financial crisis of 2007, 2008, we're fast forwarding a little bit. And we start to see the problems of the eurozone itself. So we have a shock to the economy generated from the financial sector in the US in particular that goes through the financial sectors of the world and then affects real investment, real variables. But then we really start to see the the economic architecture of the eurozone becomes one of the main problems. Then it's no longer these financial shocks; it's the very nature of the eurozone. And as I said, it's the fact that the European Central Bank does not automatically guarantee the debts of its member nations. So there is no lender of last resort, effectively. And so what we see here is that Greece, it's the interest rates that it must pay on its bonds skyrocket, as do Portugal, Spain, and Italy, but not to the same extent as in Greece. It really does skyrocket up to 26-28% or so. And this is relative to German government bond interest rates. So German government bond interest rates are around 0%, 1 or 2% maybe. German and then Greek bond rates are up in 25% region. And that reflects the perceived risk of default in Greece relative to Germany. So it's the riskiness of investing in a Greek bond. And it shows the difficulty that the Greek government has in trying to raise funds for any spending that it needs to undertake in order to ensure full employment and other desirable outcomes in its economy. But in particular, unemployment, as we saw, is dramatically high, and the government has been disabled in terms of trying to fiscally expand in order to create those jobs, because it cannot finance such a fiscal expansion, as the lender of last resort simply isn't there or isn't cooperating, if you like. We do see this sort of turnaround. As you can see already in 2012, there was quite a dramatic fall. This is largely to do with Draghi taking over the ECB and declaring that the ECB will do whatever it takes, which is largely considered the moment that investors somehow realize, okay, the ECB is not going to let the eurozone disintegrate and Greece default.
There's another message that I want to tell you today, is that within our mandate, the ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
It will be enough, he says. This is the sort of grand declaration that is meant to assure and, is largely seen as reassuring the financial markets that the ECB will step up its measures in order to help the likes of Greece and other struggling eurozone nations. What is one of those things it does? Well, in 2015, as we see here, it greatly increases the amounts of quantitative easing that it conducts. So the amount of money, essentially, that it prints in order to buy bonds, either from the commercial sector, which it was already doing from 2008 onwards, but now also from 2015 onwards, it's buying government bonds, which actually doesn't help Greece all too much, because it can't buy from Greece under its self-imposed rules because Greece is considered too risky, but it helps the eurozone as a whole insofar as the government bond interest rates fall as the ECB buys up many of those bonds on the secondary market. So this is the key point to make. The question of the legality of the ECB buying bonds is kind of always under question, because if it were to buy directly from a government at source, then it could be accused of treating one economy or one government better than another. And so it's by its own mandate is not allowed to do that, but there's apparently nothing stopping it from buying government bonds on secondary markets. So after they've been issued and held by financial investors, they can go to those investors and buy them off those investors, and therefore control or have an influence on the interest rate paid on government bonds. So that's the increase in the balance sheet of central banks, so the total value of assets as a percentage of each economy's GDP. And we see that at the outset of the crisis, every major central bank really pumps up the value of the money it's printing to buy first mostly commercial bonds, but also government bonds, and therefore injecting liquidity into the system with the hope that it will prevent hoarding and encourage lending. That is a real question mark about the effectiveness of this quantitative easing, but this is what we have. Okay. The other sort of big innovation, if you like, from the central bank perspective, or at least from the European Central Bank, is negative interest rates. Here we have data for the ECB with the deposit rate in blue. The deposit rate is the interest rate that the commercial banks earn if they deposit their reserves at the ECB. Now, of course, the ECB did not want to encourage excessive, saving in a sense. So its deposit rate is very low. So there's very little reward for depositing at the ECB, and then it goes down to zero. And then in 2015 or so, end of 2014, we entered a negative territory, which means effectively that as a commercial bank, any excess reserves that you leave at the European Central Bank, you have to pay the European Central Bank interest in order to store your money there. The hope is that in doing this, you essentially ensure that, well, commercial banks lend out as much money as possible, do not have excess reserves, and that's likewise the deposit interest rates at commercial banks also falls to the lowest possible level without individuals going out and taking out all their cash from commercial banks. But this is considered quite a break with conventional, at least typical monetary policy. And we see that the interbank lending rates, which is of course influenced by the rates set by the ECB, also then goes into the negative territory thereafter. So yeah, we see this reaction from the European Central Bank. Last part of this, well, at least this part of the lecture on the timeline of the Great Recession regards austerity. And of course, because there are various economies that undertook measures that we could call austere or austerity measures, and they took place over different points in time, I can't say exactly when this happened, but largely after our emergency Keynesianism response, we have the widespread kind of increasing popularity of austerity measures. In particular, we have, of course, the conditions for bailouts imposed by the Troika of the ECB, the European Commission, and the IMF, especially in Greece, Ireland, Portugal, and Spain. No more so than in Greece, of course, where between 2007 and 2017, we have 14 bailout packages which are conditional on the Greek government ensuring that certain austerity measures are put in place. And these austerity measures include increases in tax rates, public sector pay cuts, lowering retirement age across Greece, the decreasing pension payouts, essentially everything that the opposite of a Keynesian stimulus package, is agreed to in these austerity-dependent bailout packages. Of course, leading to massive political frustration and trouble. And of course, perhaps this is not the end of these austerity measures either. This could perhaps continue. In the UK, interestingly enough, on the other hand, we have austerity imposed without financial necessity, or at least without a power dynamic ensuring, that, you say, the Troika says you must impose this austerity. It's self-imposed because it's considered politically reasonable, and the argument is often that, well, the government is like a household and the household can't spend too much. and so it must save more and spend less, which of course from a Keynesian perspective makes very little sense whatsoever, because spending is your income. Okay, before we finish up on this video, just to try to get an idea of the effects of financial crisis and austerity in Greece, we have real GDP per capita between 1999 and 2019 for Germany and Greece, and we see that in both economies it's rising up until the bursting of the bubble and the financial crisis. And in fact, there's a little bit of convergence, in fact, going on between the two economies. But then while Germany, of course, had a short recession, relatively speaking, Greece has prolonged depressions, a prolonged depression, which in some sense has not even really ended yet. If you compare the peak value of GDP per capita in 2007 to 2019, it's still down by around 4,000 euro per person. So the material welfare of people living in Greece has yet to fully recover, and in fact, rather than a lost decade, it could end up being close to 2 lost decades. Time will tell, but the real effects of these austerity packages are seen in, well, the lack of growth in Greece, especially compared to its stronger European economy or neighbor. Okay, so that's it for this video. In the next video, we're going to discuss some of those, the general framework in which to understand this Great Recession, and hopefully use that as a model to inform our view of instability more generally. And we'll look at the specific causes and consequences of this Great Recession in particular. Okay, that's it for now. See you in the next video.